Today, our stock analysis will focus on the renewable energy company Enphase, ticker ENPH. The stock price has dropped more than 30% over the past year, and this might be a buying opportunity. So let's take a quick minute first to look at their financials. And starting off at the top with revenue, though 2023 is slightly down from 2022, but since 2014, it has grown more than 550%. Next, net income and earnings per share. We could see in the earlier years, up until 2018, these were negative, but since then, positive and pretty much growing, with net income up more than 170%, while earnings per share have increased 150%. Now, the company does not pay a dividend, so we'll move on to the share count. And from 2014 to 2022, we could see a good amount of dilution, with share count growing from 43 million to just over 144 million. So an increase of about 230%. However, 2023 slightly down from the prior year, and for the first 6 months of 2024, it is down a little bit more. So good sign there. Lastly, free cash flow. A few negative results in those earlier years, but since 2018, they've been positive, and since 2019, free cash flow has grown more than 350%. Now, since this company only turned gap positives in 2019, and that's also when free cash flow started to exceed 100 million, we're going to remove all the prior data for net income, earnings per share, and free cash flow. So basically, everything up from 2014 through 2018, we're going to delete that as it would significantly lower our valuation. Now, with the data from 2014 through 2018 removed, let's jump down and perform a stock valuation. Here's the valuation setup, and we will look at a few other scenarios in a moment. First, I want to point out I am using a healthy 80% margin of safety, and this is because their Q1 2024 results weren't the greatest, and until interest rates are lowered, Enphase might not have as good of results as they had in recent years. Now, up in the top right-hand corner, the net income CAGR over the last 5 years, just over 28%, and earnings per share CAGR at just under 26%. But for this first scenario, I am being a little more conservative, using a short-term growth rate of 15% over the next 10 years with a 10% discount rate, and I am using a 3% long-term growth rate. And that gives us an intrinsic value of $98, and with that 80% margin of safety, brings it down to $78.41. Now, the stock price just fell below $100, so it's trading about $99, about where the intrinsic value is. But for me, not sure if the stock price is going to get down to $78, but if it drops to the lower $90, really considering taking a position and using a conservative short-term growth rate. I think there's an additional margin of safety already built into it on top of the 80%. So I think at around $90 or so, definitely a good buying opportunity for Enphase. But I know this was more of a conservative scenario. So let's tick up this short-term growth rate from 15 to 18% and see how it changes the valuation. With a short-term growth rate of 18%, intrinsic value jumps up to $124.58, and with that 80% margin of safety, it brings it down to $99.66. So about where it's currently trading. So if you want to be a little more bullish with that 18%, this is definitely looking like a buying opportunity here. But let's look at one other scenario. We're going to increase that short-term growth rate a little higher, not getting as high as the what they did over the last 5 years in that mid to higher 20% range, but we're going to jump it up to 22%. Taking into account that interest rates will be coming down maybe next year, helping Enphase with their revenue. So let's change that 18% to 22%. With a 22% short-term growth rate, intrinsic value jumps up to $171.26, and with that 80% margin of safety, brings it down to $137. So if you're really bullish on Enphase, this definitely looks like a buying opportunity with the stock price currently trading at $99. But let's look at a few other scenarios first before we move on. And the first is the PE ratio. So they do have quite of a high PE ratio at just over 52. So they need to take that into account. Long-term debt to free cash flow, I like to see under 3. You can see they're 2.2. So I like to see they're controlling their debt. We already mentioned during their financials, they don't pay any dividends, so we don't have data there. But the share count over the last 10 years, it's grown 234%. Though last year it did go down in the first 6 quarters of 2024. It has gone down a little bit more. So that is a good sign, and hopefully they can keep that trend moving forward. And then net profit margin. I like to see 10% of higher. We can see over the last over the last 5 years, just below 18%, and over the last 3 years, 15.6%. So good on their profit margin. And then return on invested capital. I have to see 10% or higher, and excluding from 10 years ago when a company wasn't profitable, all the other years, 5, 3, 1, see 20, about 20% or higher. So a good sign there. Now, let's move on and we'll look at my portfolio's performance next. Here's the portfolio's overall performance and a few investments I point out. First, Tesla, TSLA. The stock has had a nice run over the past week or two. And yesterday it did break $200, but closed around $198 for the day. Though it has had a nice run up in one of my accounts, you can see I am slightly down still, but heading in the right direction. Next, NVIDIA, a little bit of a pullback this week, but still a great performer for the year. And then Palantir, PLTR. Some recent news this week on some contract wins, helping the stock get back above $25 a share. And lastly, Builders First Source, BLDR. Stock did drop under $140 this week, and I did add to that position, though I am still down, but do have an optimistic outlook long term for that stock. Now, I hope you enjoyed this video, got some useful information. Hope to see you next time. Thanks for watching.